Hello, everybody. My name is Max Van Been. I am Global Head of Client Impact at Edge Impact. Welcome to the Roadmap to Compliance, navigating the evolving landscape of compliance with the Australian Mandatory Climate Disclosure, financial related disclosure legislation. This is a joint webinar between Edge Impact, BDO, and Transurban. We've got 90 minutes together here, and we're going to get down to the nitty gritty of all things mandatory climate-related financial disclosure, AASB, ASRS1, ISSB. In fact, every single acronym that you can think of. Everyone knows that if you join a webinar, the more you can demonstrate that you've been listening to acronyms, the better you're demonstrating your time to your boss at using your time wisely. The discussion has really come around a demand from our clients to make sure that we're getting down to the detail of the Australian Sustainability Reporting Standards. So you may have read some stuff about this, you may be across the context, but now we're faced with what do we actually need to do about it. So that's the purpose of today. If you're here for a 101, the background and the reporting context, maybe that's another one. We can share some info at the end, but today we're going to get stuck into it. Before I do, I would also like to acknowledge the traditional custodians of the land which I'm calling from, to the Gadigal people of the Eora Nation. We pay our respects to elders past, present, and emerging, for they hold the memories, traditions, and the culture and hopes of Indigenous people, and recognise their struggle for justice, rights, and recognition. I'm going to quickly introduce our three highly intelligent and highly acronym literate individuals who will be driving the discussion today. First of all, we've got Mark Siebentrip. He's a director at Edge Impact and also head of the Climate and Carbon Resilience team. He's a director of multiple boards and have been working on climate change, risk and advisory, and livable cities for close to 20 years. He's also a GAICD graduate and a governance specialist. I can tell you, from those who've seen Mark in full swing, will attest that he's truly one of the most knowledgeable individuals when it comes to all things climate risk and climate governance. Kevin. So we've got Kevin Frobus. He's also a partner advisor at BDO, 25 years experience in accounting advisory, corporate reporting, consulting, and ESG reporting. Kevin, basically works directly with CFOs and finance teams to help them navigate the ever-shifting corporate reporting landscape. And of course, Amy Hogan is head of ESG and sustainability at Transurban and responsible for the development and implementation of Transurban sustainability strategy. She's also a director at the Sustainability Supply Chain School and a member of the advisory group for GBCA. And most importantly, she's the only non-consultant on this discussion today, which means that she can get stuff done, unlike all of us who just advise people how to get stuff done. So there are three fantastic panelists, and we'll be having a discussion in a moment. I'll be asking them some questions. But if you have any questions, feel free to put it in the chat, please. And we can address those at the end. There'll be time. If you can put your camera and mic on silent in the meantime, that'd be great. So before I ask the panel some questions, I am going to do a little bit of a quick overview of the Australian Accounting Standard Board's regulations in terms of mandatory climate-related disclosure. And Australia is actually the fifth, I think about the 15th jurisdiction globally to have some sort of climate-related financial reporting mechanism. So broadly speaking, these disclosures require an entity to report on the material impacts of identified risks and opportunities associated with climate change on their forecasted financial performance, income statement, cash flow, balance sheet. So what we're looking at here in terms of the ongoing consultation around this particular piece of legislation and the standards that sit behind it, there's been 2 rounds of consultation from Treasury. The first one was in December 2022. The second one was in June 2023. Of course, the draft standards came out in October. And then we're currently going through a consultation period. The draft legislation was released in January 24, and we're going through a consultation period now until March 2024. I believe it finishes on March 1st. So what we're seeing at the moment, according to that, is a commencement as of July 1 this year for Group 1 reporting entities who will have to start reporting in July 2025. Just a very, very quick overview of the standard itself, and I'm going to let the the group expand, particularly the panel, to expand on the details of some of this, but I'll quickly run through it very quickly. It's required, mandatory reporting is required for all entities that meet the prescribed size thresholds, which I'll show in a second, that are required to lodge financial reports under Chapter 2M of the Corporations Act. Reporting entities and associated compliant dates are broken down to these three cohorts here, which I've got down here, which is essentially FY 24-25 for Group 1, FY 26-27 for Group 2, and FY 27-28 for Group 3. It is built around three reporting standards, ASRS 1 and ASRS 2, the Australian Sustainability Reporting Standards 1 and 2, and also ASRS 101, which are broadly aligned with IFRS 1 and 2, which we will discuss in a minute. A lot of acronyms there. It does build on essentially TCFD and IFRS as well, requiring organizations to disclose how climate risk and opportunities are addressed through their core four pillars of governance, strategy, risk management, and metrics and targets. Bear with me one moment, please. Importantly, it requires detailed and quantitative disclosure of the current and anticipated effects of climate change over the short, medium, and long-term financial performance, including impact on balance sheet, income statement, and cash flow. And we'll get into that in a minute. I know there's a lot of words. You need to consider two scenarios. One of those scenarios must be aligned to the most ambitious global temperature goal. And importantly, it requires reporting of scopes 1, 2, and 3 emissions. 3 were deemed material. Assurance on 3, they're giving us around 1 year grace for that. Importantly, this reporting needs to be included in the annual financial reports and director's report and issued at the same time of the publication of financial statements to ASIC. And finally, civil penalties are likely to apply. So I know that's a lot of words, and we are definitely going to break that down together in this discussion, but it's important that we all kind of have a quick overview of that. There are, I've just going back to those dates. We are talking about really your soonest, or if you're in cohort 1, what is your reporting period as of July 1 onwards in 2025? If you're in Group 2, your reporting period for July 1, 2027 onwards, and then July 1, 28 for Group 3, just to clarify those dates. I should also say that through the consultation, there may be an extension to those dates, and that is something else to consider as well. Probably only a 6-month extension if that does occur. There are a few key differences between the International Sustainability Reporting Standards and the Australian Accounting Sustainability Board. I'm not going to go to those in detail now. You can look them up. But broadly speaking, it's worth saying that compliance to the Australian standards does not necessarily give you compliance to the international standards. So it's worth noting. And that we are encouraging any organisation with an international footprint to align to ISSB. All right, just very quickly, because this is going to be how we structure the discussion. The requirements really require the legislation really requires 3 major things and 3 major steps in order to comply. The first one is understanding your climate risks and opportunities. So you need to establish your baseline carbon footprint and have demonstrated some sort of climate-related physical and transitional risk screening for risks and opportunities. Step 2 is a detailed risk assessment, so diving into the high risk ones of those and also integrating that risk into your enterprise-level risk management framework. And 3, translate those material, physical, and transitional risks into forecasted financial impact, including financial reporting. So there are 3 major steps. I have taken 10 minutes to review those because it was important that we all get on the same page. Now, this is all words, and I think a lot of us have heard a lot of words floating around recently. The question is, what do you need to do to comply? What does this process look like in terms of the tasks that you need to do internally, in terms of engaging stakeholders within your organization, in terms of integrating with your reporting, your existing reporting requirements. So I'm going to start off with, excuse me, I'm going to stop sharing my screen. And we're going to start off with the discussion with Mark, if you don't mind, Mark. Look, as was the case with TCFD and now with ISSB and AASB, the first stage in this process is to undertake some form climate risk assessment. What is a climate risk assessment, Mark? You are the climate risk assessment guy. What does it look like? What does it mean in practice?
Well, thanks, Max. And just to kick off, I also wanted to recognise that I'm coming today from the lands of the Kaurna people and pay my respects to their elders, past, present, and emerging. Before I jump into that, Max, I also just want to reflect on, I think we're at a significant moment in time here. I've had the good fortune of working in the sustainability services industry for about nearly 25 years now. And I can remember two other times in my working life where there have been significant changes where an industry, group of professionals, in a broad brush sense across profit, not-for-profit sectors were involved in big change. And I think this is the third largest one in my career, and really something I think is going to have the most profound impact. I think you're right, Max. One of the big questions is around, what does climate risk assessment actually mean and how do we do it in practice? So what I'm going to do is unpack a little bit from our perspective and our experience, what we see around physical and transition risk. What are the way that we normally look at unpacking that with our clients and key stakeholders we speak with? And then perhaps more importantly is just provide a few little reflections on what we've learned along the journey around perhaps what works and what doesn't work. So Max, I'm going to share a couple of slides here to get us going. Let's go into screen share mode. So many of you will recognise this little diagram here. This is an absolute ripper from going back to TCFD documentation back in 2017. I always love it because it talks about the relationship between risk and opportunity, as well as financial statements, which, in the context of today's discussion is really, really significant. And so while, there's clearly a lot of references to things like scope 1, 2, and 3, emissions footprinting and a lot of the disclosure requirements that are coming through, the other big piece is really around physical and transition risk. And so for some of you might be tuning in who perhaps aren't as familiar with those concepts, I'll just break them down a little bit. So when we're looking at physical risks or opportunities, we're really looking at that in relation to impacts of a different future climate. So, that might be things like extreme heat in the future. It could be change in bushfire conditions, could be changes in floods. And they're the sort of things that typically we'd look at as being acute events. They're the sort of things that typically make the news headlines. If you're scrolling through your news feed, there's sort of things that are going to jump out in terms of how communities and businesses are dealing with those acute events. Also, there we have chronic events that sit in the background, and these are a little bit more insidious perhaps, but they're things like just average changes in temperature or average changes in rainfall. And, if you're a farmer out on the land producing crops or raising livestock, you know that those slow background changes are the sort of things that can change your production as well. So when we're looking at physical risks and opportunities, we do need to look at both the acute and the chronic. Instantly transition risks, while we use them sort of often in the same breath when we're running climate risk assessments, transition risks are really a different thing altogether. We're looking there at the risks and opportunities that relate to the move to a low carbon future or low emissions future. And if you look at the textbook definition, there might be things that relate to policy, could be technology, could be market changes, and also regulation impacts. Interestingly, though, even when that rolls off the tongue, the question might be, well, what does it actually mean in practice? And I think we do spend quite a bit of time working through with clients, just unpacking some practical examples. And I think for those of you watching again the news feeds and what's happening in the policy world around Australia, we've got a really interesting example of what I'd suggest as a transition risk/opportunity just come up in recent weeks. So it's exciting. We've got the fuel emissions standard that the federal government has now started to discuss. And ultimately, that's designed to say, how do we, as a broader community, as a country, start to head down that journey on reduced emissions linked with vehicles? So it's a good example of it's a policy change that's coming through. It's designed towards contributing to reduced emissions. And it will also present both risks and opportunities depending on where you sit across the supply chain around vehicles. So really interesting practical example. Another example that we're often discussing with clients is around market changes. And so, while we don't have a carbon price as such in Australia at the moment, we've got a number of clients who are actively looking at how they're working with a carbon border adjustment mechanism in Europe, where there is essentially a carbon price. So, transition risks are the sort of things that, while they may not be as immediately obvious as a heat wave or as a bushfire, as a storm event, they're definitely here. They're definitely things that our clients are working with, and they need to be unpacked and considered. I suppose the next question we get to when we're talking about looking at physical and transition risks is, how do you actually do it? If you're actually looking at getting in there and practicing doing this, what's the process look like? Max has already referred to this idea of a phased approach, and this is absolutely the way we like to go about it. So rather than trying to come in and understand risk and opportunity all in one hit, it's how do you really break it down into chunks? And I've always been a big fan in general of the work that NCARF did. Many of you remember the National Climate Change Adaptation Research Facility. It was around from 2008 to 2018, did some brilliant work. It's got a nice little framework in there which talks about a 3-pass risk assessment process. And essentially what we're doing there is we're building the granularity in which we're looking at our understanding risks and opportunities. And I often like to think it's sorting out the wheat from the chaff. So how do you go from a broad understanding of bigger issues and then slowly refine your approach through time? And so if you're looking at if you're an organisation, whether you're in the profit or not-for-profit sector, you might say, during our initial phase, all we're trying to do is understand at a very high level what are the type of physical and transition risks or opportunities that might be relevant to us. Is it that extreme heat is something that we know might impact our assets or the goods we produce or the services we offer, or is that it's completely irrelevant? So at that initial stage, you're just trying to get your head around broadly what's relevant or not relevant. By the time that you're getting into the second phase, what we typically find is you're looking at how do you start to integrate and align and relate your understanding of risks with enterprise risk frameworks. So the vast majority of larger or even medium to larger organisations will have some form of an enterprise risk framework where they state how do they assess likelihood, how do they assess consequence, and how does that then relate to risk ratings? And that's all aligned to quite standard ISO 31000 type approaches. And so as you move from phase 1 to phase 2, you're really trying to start to translate your understanding of climate risk into a language that makes more sense through a more traditional risk lens that exists for individual organisations. I think what's really interesting then is for some organisations, that's where it might end. But for others, particularly as we're heading down this path of wanting to understand financially material impacts, is you might then want to go through into that third phase where you're doing much more detailed modelling. So it could be, for example, that you've identified that extreme heat has a big impact on your vintages if you're in the wine industry, in the wine game, and you might have specific models where you're trying to understand even subtle impacts of, say, what happens if we get hit by a 43-degree day versus a 44-degree day during vintage, which is absolutely a real issue that some organisations would be facing. So what we're saying is you don't step in and looking at physical and transition risks and try to answer it all in the first pass in a short period of time. It's about how do you increase the level of granularity as you go through time. And as you're increasing that granularity is understanding more and more about the financial implications of that, which then ultimately feeds into the world of people like Kevin, where you're trying to understand what that all means for whether it's a P&L or a balance sheet. A little point to note here is that what's coming through in the Australian Accounting Standard Board standards at the moment is there's reference there to at least 2 scenarios. So the minimum scenario there will be a standard low emissions scenario. One of the things I find interesting, and it'll be interesting to see as well how this washes out in the consultation, is that there's some discussion and debate as to whether there should be an agreed upper temperature limit scenario. I think my observation would be if that we don't have an agreed upper limit, it's going to make it really interesting as to how organisations report on material financial impacts, particularly if we're using different emission scenarios. So for those of you who've got your head into emission scenario, that's a whole interesting discussion in itself, whether we need an agreed upper end scenario or not. But that's probably a discussion for another day, Max, or later on in our session. What I want to do, just in rounding out, is really touch on a few of perhaps what are some of the observations we've made through time about the tin tax or the practicalities of how you go about doing physical and transition risk assessments. The first one here is really looking at how you use your corporate memory. So, for for everyone around the call, there'll no doubt be some form of general advice around how climate change could impact your sector, whether you're in agriculture, food production, retail, infrastructure operations. There'll be some general information, but almost always there's not going to be a specific model that you can just press the button on that tells you how does climate change impact your business model and what's the financial impact. It really just doesn't exist. And so the opportunity here is, say, how do you blend your corporate memory, the knowledge of subject matters experts within your organizations, whether it might be for your engineering teams involved with, say, assets, or your operations teams, or your finance teams, or the sustainability teams. So there's an opportunity here to know how do you combine both what's best practice in terms of literature along with your existing corporate memory. The second point here is really picking up on something I touched on in the previous slide, and I've referred to it as in do risk your own way. So how do you align your understanding of physical and transition risks with your own enterprise risk framework? And the reason we say that is where ultimately this whole process is geared towards understanding financial materiality of risks. But what we know is that if you're an organization, for example, with a turnover of, say, let's say $50 million or $100 million versus one with a turnover of over $1 billion, your consequence criteria with your enterprise risk framework will be very, very different. And there's not really a one size fits all there. So it's really important as you get into going down that path of further refining your risk assessments is to make sure you're aligning it with your enterprise risk framework. And that needs to be, in our experience, it's much, much broader than just the financial consequence categories. It's going to be things related to human resources. It'll be also in relation to reputational risk and also operations. So doing risk your own way really means how do you align your approach to climate risk assessment with your existing enterprise risk framework. The third little tip here is how do you learn from the past? And what I've said here is look to the past to understand the future, but recognize the future will also be a little bit different. Now, it might sound like I'm talking in tongues there, so I'll unpack that. What I mean there is that there will have been, in many instances, past events that give you insights into, if we look at physical risks, there'll be past events that give you a little bit of idea as to how your organisation might respond to the future. A good example is if you're in Sydney, you might look at, say, the 2019-2020 summer season where we had significant bushfires and say, well, how did that bushfire season actually impact our operations? Did it impact the way our buildings functioned, the way our staff operated? Did it have a direct impact on our assets? So you can look at past events as an example of how you might have responded to a certain type of physical risk, and that can give you a bit of a guide to the future. You might also look at things like extreme heat, or it could be flood. So, for example, using Sydney as another, back in 2022, Sydney had a number of extreme weather events, although colleagues are telling me it's been heavy rainfall happening in Sydney this past week. But you can look at past events and say, how's your organisation responded? So look to the past. My only little rider on that is that there is no guarantee that the past is always going to be a reliable guide to the future. And if I use temperature as an example, if you look at the past and say, well, you know, we're examining heat wave events that might have been 45 to 46 degrees, and we wanted to see how that impacted our staff and service delivery, that could be interesting. But, you know, one thing we know is that there's science out there suggesting that the majority of Australian capitals will end up having temperatures that exceed 50 degrees, or they'll have 50 degree days possibly by the middle of the century. And the question there would be that, is your experience in looking at 45-degree days going to stack up when you look at a 50-degree day? So I think that's an assumption there and potential limitation that you really need to probe into. So learn from the past, but also understanding what the limitations of that might be. Just a couple of final points, Max, before I hand back to you. Timing matters. I think this is a really significant one. So you know, if you are building a new suburb or building a bridge, pretty much once that decision has been made or that construction occurs, you're stuck with that. And doing retrofits could be really expensive and may require very large decisions. Whereas if you're looking at, say, HVAC systems, so air conditioning systems tends to last for somewhere between 10 and 20 years, depending on what you're getting. So over a 50-year period, you might get 2 or 3 opportunities to update your HVAC systems. And so the timing of those decisions and how many opportunities you'll get to make changes on your way to looking at, say, medium or long-term impacts. Really significant. It's not just significant from a decision maker's perspective, it's also significant from the money that may need to be spent to build up your resilience to those future changes. So timing matters, and if anyone's interested in this idea around timing, there's a brilliant article done a number of years ago by Mark Stafford Smith and colleagues, which talked about decision timelines. It's an absolute ripper. The final one to make here, Max, before handing back to you, is think about the end at the beginning. And so really what I mean by that is the more you can understand how financial impact analysis will occur right at the end, the better off you'll be, because you can start to identify how you bring that in at the start of your process. So, for example, if you did know that understanding how floods could impact freight logistics, and that was part of the models, financial models that your organisation ran, that would be brilliant to know at the start of your risk assessment process. So really invest at the start in understanding how financial impact analysis occurs in your organisation. So Max, that's just a little bit of a window into physical and transition risks, what they are, how you could take a staged approach. But yeah, a few little lessons or observations from what we've learned in practice over the years.
Awesome. Thank you, Mark. I do have one question, I think getting down to a little bit of the nitty-gritty on the physical risk assessment side. And that really touches on, exposure to extreme weather events. Do all organizations need to go down to the site level and actually go to individual sites and try and work out what the exposure is to extreme weather events at individual sites? And if so, how would they go about doing that? Or can they zoom out a little bit more of an enterprise?
Yeah.
Like, what are the sectors where they need to go down to that individual site versus zooming out?
I think if we're having that conversation, Max, I'd be saying, do you own a lot of assets? So, if you're an organisation that owns, a couple hundred office towers, or if you own a number of manufacturing facilities where you've got specific sites where literally there's an address, absolutely, I'd be looking at an exposure assessment of that.
What does that look like, Mark? What does that look like? What do you do there?
Look, you can run that through. So, for example, at Edge, we run a Climatize and assessment platform that we use. There are others that are available as well. Essentially, what you're doing is looking at specific site addresses, and you're trying to understand what's your exposure to flood. It could be bushfire risk. It could be extreme heat. But it is at a very, very high level, and it's really that idea of sorting the wheat from the chaff.
Right. Okay, great. And then if you don't do it at the site level, then you can take it back to an enterprise level screening. Is that the idea?
Yeah, so ultimately what we'd see is once you've done that initial site assessment and also broader screening of physical and transition risks, you do ultimately want to move it down into that second pass assessment where you're aligning with your enterprise risk frameworks.
And then before we jump over to Amy, and this might be a good segue, we've done our risk assessment. What is that jump? And then at what stage will you start engaging with, I suppose, the executive in terms of those risks? How do we take that step from the climate risk phase into that integration phase?
I think the one thing is the earlier the better, but one of the key parts of that step is start to understand what's the dialogue and what's the discussion at, whether it's a board level or an audit and risk committee level. What are the type of issues that are of interest? What's the language they're using? And how do you start to really align what's coming out of a climate risk assessment with the thinking and the discussions that are going on at a board or at an audit and risk committee level? So in many regards, there's the hardcore number crunching analysis, but it's also the communication side is how do you get a point where you can have that conversation to really directly inform decision making at that board level.
Thanks, Mark. All right, Amy, we might jump to you. I think it's super important that everyone hears a little bit about how this work is being sort of implemented in practice. Obviously, Transurban has a large footprint. I'd love to hear about your journey, your climate risk journey, or a journey on mandatory disclosure. Do you just want to give us a quick summary of how it's progressed for you? Well, you're on mute, Amy.
There we go.
Sorry about that. There we
Sorry,
go.
I didn't realize I was in control of that. Hi, everyone. Look, thank you very much for the opportunity to talk to you today about Transurban's experience in managing climate risk and how we're approaching the new reporting requirements. Firstly, I completely agree with Mark's first comment. I truly believe that we're at a pivotal moment in time where financial and non-financial performance is coming together to transform the way business makes decisions, which, for some of us in the sustainability profession that have been around for a long time, that's certainly something we've been, waiting with bated breath. And it's finally here. It's a bit scary, to be frank, but it's super exciting. So for those of you that aren't aware of Transurban, we're a top 15 ASX listed road toll company. Since beginning operations in 1996, we've partnered with governments to build and operate toll roads across Australia and in North America. We've got 19 roads located here nationally and are currently delivering the Westgate Tunnel project in Melbourne and enhancements to the M7, M12 in Sydney. And in terms of scale, Max, you're absolutely right. We've got a very large footprint, but our customers make an average of 2.5 million trips a day on our roads, which is pretty astronomical, particularly in terms of the opportunity that we have as an organisation to sort of influence the broader community through this transition that we're experiencing. So one of the reasons why I was attracted to working at Transurban was that early mover leadership the business has taken in climate and carbon for a number of years. We're an early adopter of TCFD, having published our 5th disclosure report at the end of FY23, and our climate change framework was developed in 2020. We're also one of the first ASX-listed companies to have our 2030 net zero targets validated by SBTi. And last year, we announced that we met our 2030 Scope 1 and Scope 2 target 7 years ahead of schedule. So this success is sort of driven by the business, very much in the markets, focusing on energy efficiency initiatives and, looking at the transition to renewable energy. But climate change adaptation plans, or CCAPs, as we lovingly refer to them as, are a really important part of how we manage physical climate-related risk at an asset and project level, both from a risk management perspective, which Mark spoke to, but also looking at it from an adaptation planning lens. And they're fundamental inputs into how we assess potential financial impacts over time, how they support our broader transition planning work, and then develop our disclosure strategies in line with the new reporting requirements coming through. So to give some colour to the climate-related physical risk program, the objective is to investigate an asset's exposure and vulnerability to projected climate change variables in line with current climate projections, while considering the infrastructure components that exist and various operational activities that are underway. Now, it's a 5-step methodology that requires a huge amount of engagement across the business, and this sort of touches on one of Mark's points previously. It requires, of course, sustainability involvement, but really critical to have the risk teams, the finance teams, our asset and operational teams, project delivery teams involved, along with, of course, external climate risk specialists like our friends at Edge, to ensure that we're really delivering kind of best practice requirements that meet growing expectations, particularly from a director's level. So in terms of high-level findings, the risk profile of our CCAPs to date, and we've done 14 of them across the business, with the remainder to be completed by the end of this reporting period. The primary differences, no surprises, is between tunnels and open roads. Broadly speaking, the CCAPs completed to date have found that the assets actually demonstrate really a high level of resilience to future potential climate change events, and that's due to the high quality of design. We do mandate and adopt the Infrastructure Sustainability Council rating tool. We've got a high standard of maintenance, operations, the use of materials, and it's really interesting conversations that we do have, and even at board level, is, it's actually the infrastructure and ecosystems around our assets that are less resilient to extreme weather-related events. So there's a huge opportunity for us moving forward to really work very closely with all levels of government to provide leadership and to see how we can support that just transition and those communities, particularly through this adaptation period. From a governance perspective, we've got a climate change governance committee, which acts as a steering group for our climate activities across the business. And we work to sort of look to have these CCAPs reviewed formally every 2 years. unless, of course, an asset experiences extreme weather. And those climate-related risks are actually reviewed as part of our quarterly and annual risk review process.
Right. So let's talk about the process of engaging people across the organisation first. Like, what teams have you engaged with throughout this journey? How did they receive the information? What sort of upskilling has been required over this period?
Absolutely. I think, it's important to remind ourselves what the purpose of ISSB is. And, again, it's really very much to sort of pull together the financial and non-financial decision-making into the business. And that really requires, everyone in the organisation to get involved. So it's pretty critical, I think, to have representation from the markets and the assets, which really are the people on the ground that are driving and implementing that change. We need to make sure that we have working very much hand in hand with the finance and risk teams. One of the focus areas for us has been to establish an ISSB steering committee, which is sponsored by our CFO, and that's to govern the implementation of our ISSB roadmap and project plan, which has been pulled together. And I think in terms of embedding these reporting requirements across the business with initially that climate lens, obviously coming out of the mandatory climate reporting, which Transurban will be captured from the 1st of July this year. It will be a game changer to have, representation from all key functions of the enterprise involved in this steering committee.
Great. Look, you've obviously gone through the first phases of your climate risk, and I don't want to, you might not feel comfortable sharing, but is there any kind of insights or examples of things that you saw through that process that was like, oh, that was a surprise, or, as you've gone through the climate risk journey, some things that you've had to focus on through that process at all?
Yeah, look, certainly in terms of preparing for the ISSB S1 and S2 standards, we think about physical climate related risk, but thinking also about the transitional side of climate is a really important sort of part of that strategy. One of the key things that we've been delivering over the past couple of months is undertaking a gap analysis of our transition planning. And we've been doing that against the Transition Plan Task Force framework, which I think is sort of considered gold standard for transition planning. And we've been using the findings from that gap analysis to really build a roadmap to identify where are some opportunities for us to enhance our approach to emissions and scope 3 scenario planning. And so, we've been spending a lot of time, particularly thinking about reframing Transurban's emission footprint from, historically it's always been reported against an operational control perspective. We're now looking to see, do we need to slice and dice that data set to actually report in a number of different constructs for financial control and equity ownership? We're spending a lot of time looking at developing a basis of prep for scope 3, starting to revisit the scope 3 targets that we already have in place, understanding what those pathways are to achieving those targets, forecasting assumptions, and of course, looking at scenario planning. We did a significant piece of work back in 2019 around scenario planning analysis, and we've picked that work up again, which importantly is required all parts of the business, because remember, climate isn't just an environmental issue. It's an economic issue, it's a policy issue, it's a people issue, it's a technology issue. I can kind of go on. And so it's a really great way to sort of start a broad scenario planning meeting when you've got all sorts of people in the room that don't exactly know why they're there. Again, it's critical to sort of get everyone involved through this important piece of work.
Yeah, can I ask though, just going right to the top, tell me about your board level of engagement. Are they on top of this? Are they, do you feel as though were they literate in this straight away? How's the process gone with engaging them, and how are they now putting that into, I suppose, their process of understanding these risks and integrating their risks across enterprise level risk?
Yeah, look, Max, it's a really great question, a very important one. At Transurban, due to our complex structure, we have we have a board and our audit and risk committee, but we also have a number of sub boards for various parts of our business, and we've got a huge amount of director interest in climate risk and reporting. And it's really interesting. They're very keen to understand, yes, this is a compliance requirement for the business. Are we prepared to manage our obligations moving forward? However, where are the opportunities for us to actually create value through this process? And I think that fundamentally is really, really important, because sustainability isn't just about reporting, and inherently we're not about compliance. We're there to create value for the business. And so I think we're definitely hearing from directors this interest around, okay, we need to dive in, we need to understand the detail, but let's kind of talk also about the strategy moving forward and where those opportunities exist for the organisation.
Yeah, great. So you're obviously a leader in this space. You've been doing work on this for many years, and there are going to be a lot of organisations that are just kind of starting this journey. But what's next on your plate, Amy? You've got this deadline of obviously July 25. What is the plan from here? What are the main things that are on your to-do list between now and July 25?
The list is big. The list is very, very long. Look, I'd indicated we've got an ISSB roadmap and project plan, which is being developed to sort of provide the governance around how we will be prepared from the 1st of July this year. There's a huge amount of work underway with transition planning. We continue to do our CCAP, delivery across the markets, both here in Australia and overseas. One of the really interesting pieces of work that we have done is a double materiality assessment for the organisation. And, that was to help us, and we run materiality assessments each year as part of informing our corporate reporting disclosures. But this is really considered best practice in support of the S1 disclosure around ISSB. So it isn't climate focused, but it's more about general sustainability risks and opportunities. And it enables us to kind of consider two perspectives, looking at how Transurban impacts the environment, people and society, but also how those material topics may financially impact Transurban. So this is a piece of work which has taken 56 interviews with stakeholders, a massive amount of employees that have been involved in getting their feedback. But it really helps us set our strategy moving forward and helps inform the ISSB roadmap to help decide and define what content we include within our corporate sustainability and financial disclosures. And so there's a big piece of work happening with the finance team, who are really our partners in crime in this space. And, I think if there's a great piece of advice to give to everyone, sustainability and finance need to kind of be hand in hand in partnership with this and co-lead this important piece of work.
Awesome. Thank you, Amy. I'm going to pass it over to Kevin in one moment. Just before I do that, there is a question that came up to me before, and maybe Mark, you can answer this question, which is, when we're thinking about climate risks, we've been thinking about transition and physical risk. Why do we need to do our carbon footprinting? What is it about carbon footprinting? Maybe Mark, you want to take this. Why do we need to do our emissions profile? Where does that fall into the risk categories? And why do we need to do scope 3 as well?
Yeah, I think the big connection here for me is between understanding your emissions scopes and how it links in with transition risk. So the bigger emissions footprint you have, the greater risk you have if there's a rapid transition to a low carbon economy. So this is where the whole scenario piece gets quite interesting, and I think understanding how that translates into financial impact. So, we're in a world where there's a slower transition towards a low carbon economy. That means that some of those transition risks won't be as great. But if you have a large footprint and there is a rapid move towards a low carbon economy, that means those risks, those potential financial risks of that happening, are going to be more and more significant for your organisation. In terms of scope 1, 2 and 3, I think there are some fascinating discussions going on at the moment around finances, for example. So if you're looking at accessing debt, Does that look differently depending on whether you've got emissions sitting in scopes 1, 2, and 3? So, what I think in the past was an interesting process to try and understand, how do I head towards carbon neutral? There's actually now increasing scrutiny around, how do you access finance and how is it influeed by your scope 1, 2, and 3, which then ultimately links back in with transition risks and understanding whether they're material or not. So, it's really for the scopes, Max, and the footprinting. It's the link back with transition risk and opportunities.
Thanks,
And I
Max.
think there's some great questions as well coming up in the
There
chat.
are
We
some
can pick up
questions
on that
we'll
later on.
address.
Yeah.
We'll definitely address those. But first, I do want to pass it to Kevin, because we've kind of touched on the climate risk piece. Amy's given us some insight as well into how to integrate that in practice within the organisation, the upskilling and engagement, and the integration with board and governance, which we can dive into a bit further a little bit later as well. But then we get down to the nitty-gritty, Kevin, which is the reporting of that, the integration with annual financial reports. So AASB requires disclosures within the annual financial reports and directors' report. What does that actually mean in practice?
Yeah, thanks, Max. And hello, everybody. Good to be here. And it's good to listen to all the introduction beforehand, because in many ways, with Amy talking and Mark talking, the finance function or the finance function involvement and how that integrates into the report is essentially, I want to say, the last piece of the puzzle. And it's the last piece of the puzzle in the sense that it's the next piece that's going to form part of a compliance reporting framework. And the finance guys have probably been last to join the party, shall we say. And if I kind of take that back to my own journey in a way, my career probably mirrors Mark's, but on the financial reporting side. So Mark's been involved in this for 25 years in sustainability. I've been doing this on the IFRS and corporate reporting side, and the twain have come to meet each other at this pivotal moment in time. And that's probably the journey of a lot of people on the call today, especially those from the finance function or the CFO hurdle. What does this look like in practice? It's probably important to break down what we're talking about when we talk about reporting or mandatory reporting. Voluntary reporting has been around for some time, and Amy can talk to that in terms of Transurban. But what the mandatory reporting is essentially a component of that's moving into the corporate reporting landscape in Australia, and it'll be a sibling financial or a sibling report alongside the financial statements, essentially broken into a couple of components: climate statements, notes, and a director's declaration. But what that is it's not the full set of sustainability reports that some other organizations might have done. It's bringing some of that into the mandatory world and essentially lodging it under a corporate reporting wrapper, or under the Corporations Act, and essentially being covered by the legal framework that directors are responsible to make declarations over and ultimately be accountable to. And this is important, to their financial investors and financial stakeholders. This isn't being driven, or the mandatory component, the target audience of the mandatory reporting in terms of climate risk and so forth isn't actually all stakers out there who might be interested in this. Is actually quite specific to financial investors. So what does this look like in practice? The real answer is we don't know yet, because this is quite unique and it's still developing. The legislation in Australia, as you say, is still going through a consultation process, and it hasn't actually quite finalized itself yet. But we're essentially bringing into the financial annual report, along with the financial statements, a sibling report, the climate-related elements and their related notes and declarations in order to satisfy investor needs in evaluating financial prospects or prospects of the business. Now, a lot to unpack there, but that is why we probably last to the party, because what we're trying to do now is take a lot of the integration and a lot of the risk assessments that Amy's been talking about and Mark has been taking about, and translating that into, shall we call it, a dollar figure. And that's the basis of what's this ultimately heading towards, because investors at the end of the day want to see what the impact is on prospects. And how do they evaluate prospects? They look at the impact on assets, performance, cash flow modeling, and so forth. So that's what this is ultimately aiming to do.
Nice. And is there going to be, based on corporate reporting in the past, is there going to be some sort of template for organizations to follow here?
Max, did you have to actually ask that question? It's a great question, because it is actually the one we get all the time. Do you have a template? it makes me run cold when somebody asks that question, because at the end of the day, yes, there will probably be a template somewhere out there. Someone's going to work on a template. But as you'll know at BDO, and you've heard me talk on a number of webinars, I don't like templates because templates tend to lead to boilerplate. And this is not what this is about. Boilerplate is the sort of thing where you grab, boilerplate information from somewhere else and you kind of make it your own, but actually it doesn't say anything about your journey and about your circumstances and about yours. So I'd like to say there'll be a template in terms of structure, but hopefully not a template in terms of actual wording, because wording equals boilerplate equals not entity specific, and that's not what we're looking for. Yeah.
Yeah, I suppose that's for someone like myself who's not necessarily familiar with the format of the reporting that gets submitted. It's how much qualitative information, i.e. words and narrative, are going to be in these reports as opposed to just numbers.
Yeah, that's a good question, and maybe I'll take a step back, because I'm talking at you and thinking probably an assumed knowledge in terms of how financials are prepared. And Max, you're right. Everyone on the call is probably coming from a different point of view as to the financials. And the financials generally, the way it comes together, it's an aggregation of information, and it's organized into terms of the structure. If we take financial statements, there's financial statements, asset balance sheet, cash flow statement, notes explaining everything, policy notes, and so forth, and then the declaration over that. If we take what's going to happen here, and let's assume there's a base disclosure. Climate statements, and I'm thinking we're going to have numbers, scope 1, 2, and 3. We're going to have notes to support that. And then the idea on that is essentially to build that up to some sort of financial impact analysis. But in this case, it's probably going to be qualitative first. And the reason for that is the standards are essentially based on the original TCFD framework, which has flowed into an IFRS S2 framework. But essentially, it's going to be very much about description of your processes around governance, strategy development, risk assessment, and so forth in the first instance, because that needs to be described to your financial stakeholders firstly to indicate that you can do it, but secondly, so that you can build your models on top of it. You can't build a model, I imagine, on the financial impacts of a climate risk assessment and how risk and opportunities have been evaluated if the business doesn't have processes to evaluate them. And so the first part is going to be to describe those, qualitative, but yes, there's going to be numbers, and the numbers are going to be in a phased approach. You're going to start with your scope 1, 2, and 3 measurement, because that's probably the first base number you're going to look for. Mark, you can talk to that, but you want to know what your emissions are like, form a baseline. And Amy, I think you mentioned that along the way, you probably started there at some point. But ultimately, to actually contextualize the numbers and explain the numbers that are balance sheet focused and cash flow focused, ultimately there will be some sort of modeling that'll be coming into that. But that's probably a little bit down the line. I think you'll see in the first instance, the vast majority of organizations who are on this call today will start with qualitative disclosures with some quantitative information like scope 1, 2, and 3, and then they will build that up. Bearing in mind that if we take Amy as an example and Transurban, there's probably a wealth of information in the background that they've governed gaps analysis and all these, but you're going to whittle it down to the financial impact information that talks to investors about the prospects of an organization. So it's actually just a component of that's going to end up being part of the mandatory reporting. And like I said, that's going to be qualitative probably in the first instance.
Yeah. And I suppose just want to touch on the quantitative piece. While it will start with qualitative, ultimately the standards specifically say that you need to get to quantitative, and it's likely there'll be more guidance to that as we move down that pathway. How does an organization go from something that is, okay, here we've identified a risk in relation to, say, reputation or consumer demand as a result of doing something in relation to climate, or we've got some supply chain risk, particularly in relation to a climate event that has impacted our supply chain, impacted our supply and therefore our ability to operate. How do we translate those risks into a dollar value? How's that going to work?
Yeah, it's a great question, and I want to say that this is still a work in progress on many levels. The vast majority of organizations, in terms of translating climate-related risks, physical and transition, into a dollar figure is still an early journey. And I think even the standard setters in Australia acknowledge that we probably won't see something published out there on the mandatory scope until about 2027, maybe at the earliest. That's what they're sort of focusing on. And the reason for that is because you're going to have to essentially figure out a way to translate, shall I call it, the climate risk and the scenario analysis. And I'm looking at Mark for that, because that's somewhere in there you're going to start to understand how physical and transitionalists translate into opportunities, which translates into a strategy, which translates into a business model. But the one way we are starting to have conversations about how this might look is essentially to go back to what we know in terms of modeling and in terms of budget building. Because at the end of the day, when we start to think about evaluating a business's prospects and trying to put a number on that, the evaluation of prospects is essentially the evaluation of outcomes against budgets or against forecasts. So if I'm talking to somebody in the finance team who's looking at this for the first time, I'm saying break this down into a couple of components first. Don't try and put the big daddy of models out there. Actually go back to what you know, go back to the skills you know in finance and the ones you've used to essentially build the business as it currently evaluates risk. How does a business currently evaluate risk? Not climate risk, just risk in general. Well, what it does is it builds up a risk matrix. It understands likelihood and possibility. It then translates that into strategies and actions. And at some point, the finance team will be given the task of building a budget at a location level up to an organization level, and then evaluating performance against it over the short term. So look back analysis, and then start to build, a more sophisticated model into the future, a look forward analysis. And that's the way I think we're going to approach this. Mark, you earlier in the presentation, you actually started to speak about a 3-step process: high level, understand vocabulary, then break it down into understanding the drivers, and then pulling it down into a multifaceted sort of analysis over time. Well, isn't that the same thing in terms of building financial modeling and understanding risk profiles? I think the really important thing here is the finance professionals are probably best placed to start to identify the drivers of financial performance that are linked back to the risk assessments that are being performed in terms of physical and transition risk. How do you do that? Well, the first thing is to understand what the numbers are telling you. Understand your inventory of modeling and how you build your budgeting process, and then start to understand the trends in the short term look back, so 1-year evaluation, and short-term forward look. In other words, can you build a budget next year, and can you start to stress test it, and can you start to understand the drivers in there that are being driven by the climate-related risks and opportunities, as opposed to just general business risks. And then it's a matter of essentially over time building that up to something more medium term and longer term, and understanding whether you have to partner with somebody. Not all organizations have very sophisticated modeling capabilities. Some of them are actually quite junior. So in many cases, you might actually have to bring somebody in to help you with longer term, forecasting and budgeting. But you're not going to start there. You're going to start small. You're going to start short. You're going to do a look back, a look forward, and you're going to essentially stress test this against the strategy, the business model, and the risk framework and matrix that are being done at the board level. Hope that answers your question, Max.
That does answer that question. I suppose I'd love to know, Amy, maybe we can just quickly touch on this from you guys. Obviously, you've got highly complex projects, massive investment in some of this infrastructure work. Are there existing financial models when you've engaged your finance teams that they have already developed that will help them understand and model the impact of an extreme weather event or something like that on their assets? Or are you starting from scratch?
I would probably say we're doing both. That you're absolutely right. There's a whole raft there's just such a huge amount of data that exists within this business. There is hundreds of models that are run across the finance team. And I think when we sort of think about areas that we can start to sort of dive in to develop that financial sort of methodology for climate-related impacts, we look at sort of maintenance provisions. And that's probably a really kind of, I was going to say easy, but that's probably not true. It's not easy, but it's the quickest, easiest way for us to sort of start to be able to be really clear and prioritized around where we can work with the finance team and the maintenance and operations assets teams at the markets to really better understand, what do we need to start to consider and include within our asset lifecycle models as they progress. But, again, I completely agree with Kevin. It's it's early days, really, really, really early days in this space. And, we've kind of done a couple of pilots based on sort of a flooding event that we had up in Queensland a couple of years ago. But, there's just so much work to do. And again, it's around just sort of being very clear on what you can prioritize and sort of start small.
Yeah. And I'll just come in, Amy, because I think starting with an inventory of what your modeling capabilities are, and I'm talking to the finance teams now, is probably the first step. But those finance teams have to then collaborate across the business with the sustainability teams and the operations teams to understand the drivers. I think the person who's going to make all the consulting money out there, and Max, maybe that's you and maybe that's me, is the person that can articulate how the climate risk opportunity is translated into the modeling driver, or essentially identifying when there's a modeling variable from historical trends, essentially drawing the link back to, is that a climate risk or something else, let's say. And finance teams can do that, but I don't think we're always very clear in the way we do modeling in the finance teams about what the drivers are. We tend to build, and probably talking to a number of people out there, when you do a budget every year, we tend to build budgets by saying last year plus a percentage. That's your base budget. Well, that's not how this is going to work going forward. Mark made a comment earlier. I think you said we're going to look to the past, but actually the future will be different. And I like that. I actually wrote that down when you said it, because we tend to want to budget and model on the past by last year plus a percent. That's not how this is going to work going forward. And so it's trying to find that line between, yes, there's the past, but actually I have to fold something into my forecasting and my modeling that wasn't quite known and understood, and the driver and the degree to which that's driving the financial performance isn't known. And that's where the time element comes in, because we'll learn as we go, short-term, medium, long-term, and some exemptions from the standard setters that we won't actually have to do some of these quantitative disclosures until 2027 will allow us the time to stress test those impacts.
Max, can I leave just an observation there as well? I think it's fascinating around bringing together the worlds of sustainability and finance, and particularly when it gets to the pointy end around modelling. And, I think it does come back to having those conversations as early as possible and really understanding where models already exist. And, Kevin, to your point, is there any part of that model that has some consideration of a climate risk? And so if that already exists, and the person's developed model might not call it climate risk, they might call it flood, or it might have been heat wave or bushfire. So where that exists, let's identify it and let's understand it. But also where it doesn't exist yet is to say, well, how could it factor in? So, an interesting example that's just come up in some recent discussions is if you're a property investment company and perhaps you're getting your building assets valued on, could be a 6-monthly or even quarterly basis by an independent valuer. How's that independent valuer actually consider at the moment climate risk? So if they're not getting considered at all, the question will be, how will they factor that in the future? Because I imagine, Kevin, what's going to go on is that the information coming back from the property valuer is directly, or in some ways, going to feed into your balance sheet estimates as well. So understanding how those valuation decisions are being made there, and ultimately financial modelling, that becomes really important to get an understanding of early.
Yeah, we call that a look-back assessment. And if I had to translate this into something some of the finance people would understand, your basic impairment model for financial reporting, you're supposed to do a look back each year on your budget process and understand what the drivers were. I think that is poorly understood in most organizations, what the drivers are. And even if the drivers are understood in terms of, this was the cause of that variance, we don't understand the root cause of the driver. So as you say, we might say supply chain issue, but actually it's a climate-driven supply chain issue, and that's been missed because we don't understand that the reason why the supply chain was impacted was because of some flooding event in, let's say, another country where raw materials are being sourced. So yeah, it's actually just tagging them right in the first instance is probably where you want to start.
I suppose that comes to my next question, right? Well, first of all, as a sustainability consultant, there has been a dynamic shift where previously the CFO might be the last person to come in the room. Now we go and the CFO is right there. Finally, woohoo, win. But The question that I have is really around what is the role of finance teams, or what can finance teams or CFO do now? Let's just say they're just starting the journey, right? There's still a whole bunch of climate risk assessment to happen. We've got to do physical and transitional risk. What can finance teams do now to prepare for this, even if those first full 2 stages haven't been completed yet?
Yeah. Look, I mean, I think the first thing, and this is probably obvious, but I think finance individuals need to learn the vocabulary and need to start living in the world of the sustainability professionals. And I take that from personal experience, but also I can see that in the clients that I deal with. Why is that? When IFRS and accounting standards became the norm in financial reporting 15 years ago in Australia, it might have been 20 years ago now, I think we were able to take that and translate that into something without really having to engage much across the various operational divides, and we could translate the language into something we all understood without having to engage with specialists in other fields. What's happening here is you're going to have to start to translate this at a finance level, engaging with people like Amy and people like Mark and people like Max, who have the vocabulary and the experience in the science of sustainability. So you need to first and foremost learn the vocabulary and understand what's going on here, because you can't have a conversation in a room if you're not quite on board with what are they talking about and how does this interact with my job. That's the first thing. But the second thing is probably before you even get to your climate analysis and your assessments, which might be happening at the same time, start to take an inventory of what you've got, because a lot of this is, what modeling do I have? At what level is my data collected? What systems and processes do I have to collect the information? So start with an inventory so that you can start to bring the inventory, the knowledge, and then the climate risk and scenario analysis together at some point in the future. The other thing is to probably map out a roadmap on your reporting journey. Amy made mention of an ISSB project plan. I wrote it down here, and that is a working group. I think it was ISSB working group. That is probably critical, and that working group isn't the only working group that's going to happen, because you've got a lot of gap analysis and project plans and roadmaps all happening, some of them on the risk level, some of them on the governance level, some of them in terms of measuring your carbon footprint. But the ISSB, or shall we call it the reporting working group, is the one that's going to specifically bring this all together for mandatory reporting. So it's a section of the overall sustainability journey. Someone needs to take ownership of that and actually start to drive the journey towards the drop dead reporting date, which in Amy's case is 1 July 2025, they're going to start reporting. Others might be a bit later. So inventory of capability in the finance function, vocabulary and knowledge, talking the language across the various teams, and actually start to develop your roadmap and project plan for the reporting element if it's not already underway. That's what the finance functions are going to focus on right now.
Upskilling is just critical for entire organizations, I think, across the climate space and sustainability more broadly. It's, it can be such a challenge writing a board paper or a paper for the executive when they're just can be so technical with very complex interrelated issues. And so just ensuring that, I think, from an organizational perspective, you have a very mature approach to just upskilling everyone within the business. Absolutely. It doesn't matter what functions you are. And look, I mean, I agree with Kevin. I think the sustainability people also need to start to put a bit of a financial lens on. That's really, really, really important, because, historically, we have never really worked. It's always been hard to speak to finance.
Yeah.
So ensuring that we do have that right language, and just that sort of shared sort of one goal that we're all trying to achieve in the longer term, is really, really important.
Is it worth me saying at this point that check your ego at the door? Because I don't think the sustainability and the finance and the operations teams all worked very nicely together in the past. And that's one thing I think you need to do, is walk in there with an open eye, understanding the skills you bring, but understand the skills the other person brings. And that's really important.
Well, look, I've been pleasantly surprised working with finance teams, I must admit. Kevin, you're a great example. It's been good having this opportunity to work with you. And so I'm yet to be disappointed on that front. But I'm going to jump to some questions now, and open slather, whoever would like to answer this. This first one's from Muddy, and it's really around any tips on being able to report within the financial reporting timeframes, say August, rather than that of NGAS, say end of October. So we're relying on invoices for data that often doesn't come until September. So someone want to expand on sort of reporting timeframes, how organizations can line up these reporting requirements. Does it all have to be on July 1? Does anyone want to take that?
I'm happy to give an initial perspective on it, Max, and perhaps I'm not answering the question directly, but I think it points to the importance of using this current year as a trial run. So really, we've got training wheels on this year, and what's been identified here in the question is there's a misalignment between when data is available versus when future reporting will be required. And so the question that in that case there I'd be asking in the next sort of 3, 4, 5 months in that organisation is, if we are going to need that data that is normally only available in September, if we're going to need that data by early July, how are we going to make that happen? So yeah, there's a recognition here that the reporting timeframes are different, and really this coming season is the one opportunity to try and resolve that, particularly for the cohort or the Group 1 companies who need to hit the ground running with their disclosure reports as of 1 July 2025.
I mean, we haven't really talked about assurance, have we, yet? And, I think it's really critical for organisations when they kind of go to market with data and disclosures that data and those disclosures receive third-party assurance. And, certainly with the new standards coming through, and from Transurban's experience, our Scope 1 and Scope 2 emissions, we currently have limited assurance over that, but we will be moving, fingers crossed, to reasonable for this reporting period, and we'll have to achieve that next year. So it's really, I think working really closely with your assurers is a really important part of this process. And if you haven't spoken to your sustainability assurance team yet for year end, I would set up a meeting for next week just to sort of sit down and start planning for are you ready for that? And I think that's going to be a really important part.
I probably won't add too much to it, but I'll structure it slightly differently to what Amy just said. When we talk to clients on this journey, there's roadmaps and there's certain work streams, and you've got data which feeds into numbers and so forth. What our auditors are talking to clients, they talk about a pre-assurance, which is what Amy's talking about, is getting your auditor to actually have a go without issuing the report on telling you where your systems and processes have fallen down, so that either that's not a valid data input or that one's a scope limitation, we couldn't actually assure it either way. And all of those work streams, especially with the later groups, Group 2 and Group 3, you almost get a couple of years to test them before you have to put numbers down into the public domain. Group 1 is different. Group 1 is, starting 1 July 24 is their period, but a lot of the Group 1 entities are already on this and already starting to do these tests. So the takeaway from it is financial reporting had to work out a way to make sure the data could be gathered and available on time. And this will happen as well over time, is that you will figure out your systems and processes to make sure that the data is available on time in order to make the disclosures. It'll happen over time, but it's not going to happen without effort. And the effort is get your work streams in place, understand what they are, and get the auditor to do pre-assurance work over it so you can identify the gaps.
Max, I think linked with this, there are going to be some parts of this whole disclosure space that require more data than organisations ever anticipated. And I think there's one that jumps out to me, and it's not required immediately, but it is flagged as around Scope 3 emissions reporting. That's something where regularly we'd find that initial discussions with an organisation might suggest that, yep, all the data's there, should be pretty straightforward. And then once you lift the lid and get in, it's like, oh, wow, there's a whole lot more that's really required. So, we're finding more and more organisations now, even if they're, say, cohort 2, starting to say, we're going to spend more time on looking at Scope 3 now and ensure that by the time we get to the point where we need to report it, all of our data collection processes are lined up.
I just want to touch on that because I think it's worthwhile discussing around supply chain and Scope 3. And Sasha's asked a question here, which is it what is going to be required? First of all, if you're a large organisation, what sort of assessment do you need to do to your supply chain, both in terms of emissions and in terms of exposure to climate? And the second thing is, if you're a supplier, what is going to be the impact for you? You might not be in those top groups, 1, 2, and 3, but what is the impact going to be for you? Mark, I might give that to you first, and then maybe Kevin afterwards.
Yeah, I might answer the second part of that question first, Max, because I think it's a fascinating one. And so, there's a set number of companies who will be part of that first cohort, and they're rapidly pulling their information together. But in order to generate the information they need, they will be asking questions of their supply chain. Now, if you're a company that perhaps is part of, say, Group 2 or Group 3, you might already have some level of awareness of this, and you're starting to pull your data together. So, an early heads up, if you've got, say, Group 2 or Group 3 companies in your supply chain, an early heads up that, you're going to be looking for information to support reporting in the future, that will be a challenge, or that'll be, important to do that. I think the challenge will exist for small to medium-sized enterprises who, really fall outside of some of these, the thresholds, but they're actually an important part of that supply chain still, and working out what is reasonable and meaningful for those organisations to provide. And I think this is why, we talk about this being such a profound and significant change, because while on the face of it might look like there are, there's a limited number of organisations who will be impacted, ultimately this will have an influence right across supply chains. And it's really important that organisations, I think, out there in small to medium-sized businesses, that they also start to get an appreciation of this and what information they might be asked for, because it's important that that's not unreasonable, that information, because they just won't have the resources to pull together that data. So, I think giving an early heads up as to what's going to be required from your supply chain is really important.
I do want to ask a little bit around scope, and there's been a question here, Amy, on scope 3, particularly around the challenges of drawing a boundary around scope 3. Did you have any issues with that, Amy, when you've been going through that process around what falls in and falls out of your scope 3 footprint? How far down that rabbit hole did you go? Did you just follow GHG protocol? Yeah,
I mean, we certainly use a greenhouse gas protocol as sort of our Bible for deciding what's in and out. And I think going through the SBTI process is a really sort of important guide to inform how you define your categories and what sits in, what sits out. And then how do you determine your targets? So, I think there's definitely resources out there that provide you with the support to help navigate. But it's a very challenging space. If it wasn't challenging, we'd be doing this all very, very well, and we would have done it a long time ago. But it kind of comes down to those inherent complexities around supply chain and products and services, and areas that you can't control as an organisation, but things that you can influence. So again, coming back, sustainability working with the procurements team in organisations is also fundamentally very critical to ensure that we sort of drive those sort of expectations along that value chain.
Yeah, great. This one's open, and then I've got another particular question for you in a minute, Kevin, but this one's open because there seems to be a lot of interest around a decision made around essentially government entities, local government, state government entities. Does anyone have any insight on that? I think, Mark?
I'm happy to touch on that. I think, some really interesting discussions going on around large not-for-profits, and also what's going to be requirements for federal government entities. So I think that information's coming together pretty quickly at the moment. How that translates into, if I then go from federal to the next tier of government around states, I think we're seeing, for example, New South Wales has got some, I think, very well developed guidance around expectations of mandatory reporting, which is aligned to TCFD in the past, and we'd expect to see that align with ISSB in the future. It's interesting with, local government really being a function of state government legislation. You would expect that local government's going to be influenced by what's happening within state government. I think there's already increasing pressure within the local government sector to have, say, climate action and adaptation plans, which are then reviewed and reported on through audit and risk committees, and audit and risk committees will be tuning into, emerging disclosure requirements. So I would say that, in many regards, local government has probably been one of the most active sectors in climate change action for many, many years. And I'd say it's probably an area that there does need to be a bit more clarity as to how do federal requirements, but more importantly, state requirements start to flow through, and recognising that probably will vary state to state.
I mean,
Great.
I'll just sound to that, mate. So the corporate regulation we're talking about with mandatory reporting doesn't cover those entities, but that doesn't mean they're not heading this way. So we have seen some activity in some of the New South Wales agencies looking for very similar type of work stream activities, climate scope 1, 2, and 3, covering the major assets, work plans about decarbonisation strategy. So it is the same subject matter and the same type of activity happening in those spaces, but it's just not covered by the Chapter 2M requirements in the Act. That's really just corporates. And even so, that's not for profit. So the ACNC entities aren't covered by the mandatory reporting that we're talking about in the Corporations Act. But it's coming and it's rolling out fast, as we're coming back to the earlier question. If you're in the supply chain, and especially if you're an entity in a supply chain, and one of the key risks for the organization buying from you is you. So critical minerals is a good example. If you're providing critical minerals into somebody else's, like the iPhone, you're going to be a high risk for them on climate, and they're going to want lots of information from you really quickly. So whether you're caught by this under state, government, or even corporation legislation, I can guarantee you'll be getting a letter from them at some point asking what you're doing about this and starting to provide data. So it'll happen.
It will happen. It will happen. I'm going to ask this question here. This is really around subsidiaries, because I think it's important that we understand how this is going to roll out. Someone's asked particularly, if an Australian business is part of a global group and that global group's done a climate risk assessment and double materiality assessment at the group level, and that might include the Australian part of their operations, is it still required to report a separate climate risk assessment under Australian mandatory reporting requirements?
Would you like me to take that one?
Sure.
I mean, the answer is, if you're caught by the lodgement requirements under Chapter 2M of the Corporations Act in Australia, then yes, you are caught by this. Now, what that really means is, if you're a large proprietary company, so you might be head of the Australian operations and you've got an Australian Pty Limited that reports the Australian group activities, and it is a large company by definition, in other words, Group 3, then yes, you will be caught by this regime in terms of the Group 3 reporting. You may also be caught by whatever global requirements are at the global level, but that'll probably be looked after, internationally at the global group level. But as long as you are caught by a lodgement requirement it's effectively, if you're lodging as a large proprietary company with ASIC, your financial statements, then that's a fairly good rule of thumb that you'll be caught by the mandatory reporting in Australia for that reporting entity.
And that entity, if you're the subsidiary there, you just need to report on your Australian operations, right?
Well, it'll be what you lodge with the regulator. So if you're the Australian holding company of a group of subsidiaries in Australia, and you produce consolidated accounts which you lodge with ASIC for the Australian operations, including all the Australian subsidiaries, then yes, that'll all be caught in one report.
Yep.
Max, just want to add a minor point there. I mean, I think this is interesting in terms of there's the compliance requirements. And then ultimately, the driver here is to help investors make better investment decisions. So if you're an investor interested in investing in a global company, you're going to want to understand, well, how is the performance of that global company influenced by what's happening in Australia? So this is, what you get outside the compliance reporting. Whereas if you're investing in a subsidiary which is just operating in Australia, you'll have a different set of questions. You'll be interested in different information. So I think with all of this, there's what do I need to do to just meet compliance? But then there's also, what's the really useful information that's going to be in these reports to inform good investment decision making?
Yeah.
There was a follow-on question here, which is, if the parent company has reported under the US SEC or the European CSRD, what is just essentially replicating that approach aligned to ASB? And I think I can answer that question, because I've just literally come from a presentation to a subsidiary, or it has a small Australian. In short, CSRD, in terms of its broad, you obviously have to check the individual requirements, but as a principle, ISSB requires a broader set of reporting than ASSB, and CSRD is another step up from that in terms of its granularity and requirements. So broadly speaking, although there are some small tweaks, alignment to CSRD should cover most of the areas required by Australian Accounting Standards Board. I'm very conscious of time, so I'm going to round us off with one very quick question to all of you guys, to the three of you, and there's been many, many questions which we haven't been able to get to, but I am going to do a closer because everyone likes one piece of advice questions. We all know, we all love those. Let's talk a little bit about it. I wanted to have a whole conversation around going beyond compliance and impact. I think that's a whole nother conversation and maybe a whole nother webinar, because you should not be doing this. This is obviously the topic of this was roadmap to compliance. But I think collectively we need to appreciate that we need to go beyond compliance here to have true innovation and leadership. But we've run out of time. So what we are going to ask is, I'm going to ask for one piece of advice, maybe for Mark, first of all, one piece of advice for a CEO who's overseeing an organization that's to go on this journey.
I think lean into your corporate memory. There'll be a lot of people working in your organization who've got great experience. And while you might look out to the literature to see what's the current best science and what information's out there more generally, is lean into your own people, look at their experiences, look at their knowledge, and see how do you blend together your corporate memory with what's out there in the literature.
Yeah, thank you. Kevin, one piece of advice for a CFO, please.
Yeah, look, interesting question. I mean, I could easily go and say, get on board vocabulary, understand what's happening, learn the language. I've already said that. What I'll actually say is finance functions and CFOs in particular, you need to be able to talk the language of your operations really, really intimately. If you don't know the difference between using a solvent in the production or burning it off or producing a waste outcome as part of your production process, then how are you going to actually model this and understand the financial impacts of it? So get to understand your operations as a base competency, even before you add the sustainability vocabulary on top of that, and even before you do your modeling and cash flow inventory, because you can't connect the three if you can't talk the language of your operations team.
Nice. And Amy, key piece of advice or pieces of advice for a CSO, a Chief Sustainability Officer or Head of Sustainability?
Look, I think from my perspective, you probably feel like you need to be everywhere all at once, and the spotlight is on you and it's on your team, being pulled in all sorts of different directions. But have a plan and just make friends. Learn what people do in the organization and understand what their drivers are, which really kind of reinforces Kevin's comments. And I think, when you're a sustainability professional, you're very passionate about this space, your values aligned, you're purpose driven. So it's this is the opportunity of a lifetime to really drive transformational change for the business. And how they consider sustainability risks and opportunities. We know that, it's really important that, this is from a climate perspective being driven by compliance requirements. But this is actually coming from capital markets to Mark's point, and climate's first, but nature will follow. And then we'll have human capital, and this is a tsunami of a reporting landscape, which we have to be ahead of, and that's where the value is created.
I agree. How to thrive in this new era of disclosure is the key element. How do we go beyond compliance and surviving through to thriving? And I think we have run out of time. I'm just going to quickly close that out with a few discussions and a few actions. The first one is, speaking of how to thrive in a new era of disclosure, if you look in the chat, Rachel will post a link to our latest handbook on this. And I think that the context is going, climate is just the first stage in a series of different disclosures that are in the pipe. How can we actually use this as an opportunity, not to be scared and not to be worried, but use it as a way to engage across your organization to genuinely thrive and elevate ESG opportunities more broadly. Probably if you feel like a really interesting read, you can have a read of the Australian Accounting Standards Board Sustainability Reporting Draft Exposure. You can just Google it. great afternoon. Sit down on a Saturday afternoon with your coffee and have a peruse. Have fun. I should also say, in terms of support on this journey, no single organization, no matter how good a consultancy they say they are, necessarily can do the full breadth of work here. We know that because there is a lot to do, everything from that climate space all the way through to integration with your financial reports. That's why we've actually organically partnered with BDO on supporting some of our clients. That's kind of developed organically because we had some joint clients and it seems to be going extremely well. So you can reach out to us. Our contacts are there. The other thing to say is we've just recently moved, if you're in Sydney, to the Greenhouse, which is the Greenhouse Tech Hub down in Circular Quay. So if you do feel like come and have a coffee, we have a great coffee machine here. There are a bunch of sustainability people kicking around. Just ask for someone from Edge at reception, and it's a really great place to come because it's basically just all sustainability and impact people all in one place. Big thank you, everyone, to Mark, to Kevin, and to Amy, of course. I'm just going to stop sharing my screen here. Thank you guys for joining us today. And any other last final comments from you?
No, thanks. Great to be part of it. Love the questions.
Thank you very much.
Good luck.
The recording will be available for everyone as required. Thanks very much. Bye-bye.